Hi traders, in today's video I'm going to talk about some of the important technical analysis and the terms that we use for ICT concepts and smart money trading. These are one of the most useful technical analysis that I wish I learned about them before learning ICT. It will make it so much easier when going through ICT materials and his videos. So first of all, candlesticks. I believe many of you already know about the basic of candlesticks, but let's just revise it quickly. So we only have two types of candles, bullish or bearish candles. The color doesn't really matter because you can change it to your personal liking. What really matters is how they form. We have an open, high, low, and close. The candle body represents the bullish expansion. Wicks just represent the volatility. Similarly, for bearish candle, we have an open, high, low, and close. The body represents the bearish expansion. Building on this basic foundation, let's transition to a more advanced knowledge of candlestick formation. Power of 3. It is the accumulation, manipulation, and distribution of smart money. For example, when the price opens at New York midnight, assuming it is a bullish day, smart money will start building their long positions by pairing short orders. This is called engineering short liquidity, making a forced move to the old lows or a pool of liquidity, tricking traders into going shorts. But this is where the smart money will accumulate their long positions before expanding and distributing price to a higher level. Then they will dump their long positions by selling them to the pending buy stops where retail traders are chasing prices and buying at a premium price, thinking that it will go even higher, aka the breakout traders. It will be reversed for bearish candle formation. Smart money will start building their short positions by pairing long orders through engineering long liquidity, making a forced up move to trap traders into going long, but this is where the smart money will accumulate their short positions before expanding and distributing to lower prices. They will exit their short positions by buying from sell stops where the retail traders cut their losses and they are selling at a discount price level, thinking that it will go even lower. Break in market structure means when a swing high or swing low is broken, preferably with displacement. Displacement is an energetic or strong impulsive move that breaks the previous swing high or swing low. Price never moves in one straight line. Price form new higher high and new higher low when expanding higher, new lower low and new lower high when expanding lower. But how do we identify swing highs and swing lows? We basically use 3 candles to identify them. Swing low is formed when we have a higher low to the left of it and a higher low to the right of it. Swing high is formed when we have a lower high to the left of it and a lower high to the right of it. This leads me to my next point, expansion. When looking at the market price action, we neither have bullish or bearish institutional order flow, meaning the market is neither going up or going down. For bullish expansion, old swing high is broken, market structure shift higher, new high is formed, leaving behind bullish order blocks. These down close candles represent bullish order blocks. For bearish expansion, old swing lows is broken, market structure shift, new low is formed, leaving behind bearish order blocks. These up close candles. I won't be going into full details of what are order blocks in this video. It is for another video, or you can check out ICT Core Content Month 4. For retracement, as mentioned earlier, the price never moves in a straight line. After every expansion, there will be some sort of retracement. The price can either retrace back to an order block or to an imbalance. We call them fair value gaps. They are formed when price is only offered to one side of the market. In this case, we have buy side imbalance, sell side inefficiency because price only offered to buy side. In the case of sell side, we will have sell side imbalance
and buy side inefficiency
because price only offer to the sell side. Usually we can use these fair value gaps to look for our entry setups. Whenever we have fair value gaps, price will likely to fill these gaps because price is always drawing the liquidity and imbalance. The market always want to deliver price efficiently. Consolidation is when range-bound market trading in between a clear dealing range. Price not willing to move higher or lower. This means that smart money are accumulating orders from both sides of the market before a new expansion in the near future. For reversal, price turn around and goes in the opposite direction. When price reverses, it means that the stop orders have been taken out. Usually we look for liquidity pools above all highs or all lows. Price tends to reverse from those areas. Of course, you're not going to buy or sell immediately when they reach those levels. We need to wait for our confirmation. Divergent, or ICT call it smart money tool, technique, or even tactics. So what is divergent and how do we find divergent in the market? We find correlated pairs. In this example, Nasdaq and S&P, or in Forex, you can look for EU or GU pair with the dollar index. In general, Nasdaq and S&P move hand in hand, and we know this by looking at their market structures. They are not perfect, but they move in a very similar manners and behavior. Sometimes they diverge and crack in their correlation when one is making higher low and another one is making lower low. As you can see, up to this point, the market structures is the same, but when you look here, Nasdaq is making
higher low,
S&P is making
lower low.
So this is called divergent. In a bearish environment, when a divergent forms between two closely related pairs, the market is tipping his hands to you that one with the lower high is much weaker and you want to trade that. The reverse is true for a bullish environment. You want to trade the one that forms higher low. Last but not least, Fibonacci. We don't use Fibonacci for Fibonacci's sake. We mainly use it to gauge premium and discount of a dealing range. Premium means price is oversold without using an indicator, and price is trading at a good or premium price. Just like any business, you want to buy products at a discount and sell them at a high premium for the profit. If you can measure premium and discount using your eyes, you don't really need to use the fib. But if you have OCD like myself and you want to be so precise and accurate, draw the fib to measure the equilibrium of the range to identify the premium or the discount of a dealing range. Hopefully this can be very helpful before you start learning ICT concepts. These are some of the very fundamentals for the technical analysis. These are the things that I wish I know earlier before learning ICT. It will make it so much easier, and I'll put some reference link in the description. You can check them out. Alright traders, keep on learning and keep on trading.